Welcome to the Dough Roller Money Podcast. I'm your host, Rob Berger. Today, in episode 302, we're going to talk about how to manage your emergency fund. This topic actually came up in the Facebook group, and I thought it was a good topic to cover. And so that's what we're going to do today. By the way, if you don't know what the Facebook group is, you can join it. Just go to doughroller.net/Facebook group. That'll take you to the Facebook group. And we've got about, 5,700 people in that group now. Great group of people exchanging ideas on how to make the most of your money. And this topic came up. A member named Jacob actually asked a question in the group. And here's what he asked. He said, does anyone keep their emergency fund at Ally and literally do nothing else? I'd like to put the cash to work a little bit, but I don't want to do anything with Ally except store cash in their high yield savings account. So it's a great question, and it sparked a really good discussion. I mean, the challenge today is that you want to keep your emergency fund safe. You don't want to put it, for example, in the stock market where when you need it most, half of it could be gone because the market drops. But if you put it in something super secure like an FDIC insured savings account, you don't earn much. And that can be discouraging, as months go by, particularly when the stock market's doing well. It's funny, if the stock market turned south on us and say it was down 10 or 20% over a couple of months period, folks would probably be thrilled with their 1.5% or 2% they're getting in a savings account in their emergency fund. But when you see the stock market going up, it can be discouraging. And so what do you do? And we've talked about that issue off and on over 300 podcasts. It's come up a number of times. So what I thought I would do today is tell you what I do with our emergency fund. Not that we've got necessarily the best answer. We got the best answer for us. May not be the best answer for you, but I'll tell you what we do and why. And then I'm going to give you some tips, particularly if you, like I do, use online banks to hold your emergency fund. There was some interesting discussion of that in response to Jacob's question in the Facebook group, so we're going to cover that as well. So let's start off. What do I do? So I kind of bite the bullet and say, okay, I'm not going to make a lot of money on my emergency fund. It's that simple. I'm going to make money on my other investments. As a percentage of our total portfolio, our emergency fund is quite small. And it's just the cost of security. That's kind of how I view it. And so we keep our emergency fund in actually three places. The first is in our traditional brick and mortar bank. We keep a little bit in our savings account. We do that so we can have quick access to it, right? Anywhere there's an ATM, we can get access to the money, or I can walk into the bank branch, which is just a couple of minutes from our house, and pull out as much of it as I want. And so we keep some there. Now, we don't keep a lot, and that's because our brick and mortar bank doesn't pay any interest. It's 0.01, I think. I think it's 1 basis point. So that's just, even in today's low rate environment, that's just horrible. So we're not going to keep a lot of money there, but we keep some there for easy access. Then the second place is an online savings account from an online bank. And we do that because they pay better rates. We use Ally. Jacob mentioned Ally in his question, and we use Ally Bank. There are plenty of good online banks out there. In the past, we've used, we used ING Direct years ago that then became Capital One 360, and we still have accounts with Capital One 360. I've used American Express Bank. We've used CIT Bank. Those are the ones that come to mind. I mean, they're all good, right? I mean, they all pay very competitive interest rates and no fees on a savings account. I don't know if Ally is the highest yield right now, but it's certainly extremely competitive. The other thing I like about Ally is I found their website to be extremely easy to use, which, that's of some value to us. Not that we log in a lot to our account, but so that's sort of the second place. Ally Bank or some other online bank of your choosing, you get a higher interest rate, no fees. In our case, the third place we keep an emergency fund is at Vanguard, and we keep it in a money market account at Vanguard. They have a couple different money market accounts, one that invests more in federal and government securities. But these are short-term, high-quality debt instruments. I mean, that's just effectively what money market accounts invest your money in. Now, they don't earn, a ton of interest. It's not as if, in fact, they probably aren't going to earn much more than the top online bank. There are a couple of reasons, though, why we do that. One is I like some of the money to be in Vanguard because, where you draw the line between this is my emergency fund and then everything else is whatever for retirement or something else, sometimes that line can get a little blurry. I'm not one to say, okay, I need to have exactly 6 months, there's my line, and put it over here in Ally. It's a little more fluid than that with us. And so sometimes, I like to take some of the money, I might, in certain circumstances, and invest it. So if it's already in Vanguard, then, we're good to go. We don't have to transfer it. Now, again, I'm never going to take what I deem to be our emergency fund and invest it. But like I said, the line kind of can blur from time to time. Or in some cases, we'll get some cash for some reason. We'll stick it in Ally as part of our emergency fund. And then we can free up money that's already in the money market account to invest, right? So I'm looking at, they have a couple money market accounts. The one that we've invested in is VMMXX. I was going to look up the yield for you if I get my computer to work. Let's see here. Price and performance. Here we go. It's around 2%, I think, is their yield. Well, that's interesting. For the last year, it's earned about 1.5%. That's not its yield. That's just what it's earned. Because remember, as interest rates fluctuate, price can go up and down. It's interesting. Its 10-year performance is only 43 basis points. Of course, that's going to probably, let's think here, that's going to go up, I think, over the next couple of years. I don't actually see their yield, which is kind of strange. Oh, here we go. The yield is 2.07. They have a SEC yield, a compound yield, just over 2%. So, we get slightly more from this money market account than we do Ally. It's not really the reason we put it there, but I'm comfortable with the risk, and so that's what we do. Those three places, and for the reasons that I outlined. One of the things that I'll never do is take any portion of what I deem to be our emergency fund, and I'm pretty conservative. I know the rule of thumb is 3 to 6 months. I'm more of a 1 to 2 year kind of guy. Maybe that's because I grew up with very little money. I don't know. But I'm more of a 1 to 2 year kind of emergency fund. But whatever the number turns out to be at any given point in time, I'm never going to put it in the stock market ever. And I'm never going to put it in long-term bonds. I'm never going to put it in high yield or junk bonds. I'm going to put it in really secure investments. And the reason is not just because, say, stocks can go down. We all know that. So even if you put your emergency fund, say, in Betterment, and did like a 50-50 mix, stocks to bonds, that can still go down a lot. But the issue for me is more than that. It's that the biggest emergency, you think about the kinds of emergencies you might have. The car could break down, furnace could break, whatever. Those are bad enough, but those are contained. They're sort of a defined emergency. You can have health care emergencies. Hopefully you're covered with insurance. But I think one of the sort of biggest emergencies is a loss of income. You lose your job, right? Now, of course, that can happen at any time. But it really happens a lot when we go into a recession like we did in 07, 08, 09, where a bunch of bad things happen all at the same time, right? Unemployment goes up. In that case, housing values crashed. The car industry, was a mess. And of course, the stock market lost 50%. So all of these bad things happen at one time. It's like the perfect storm. That's not when I want to see my emergency fund going down in value. And I think in good times, which I would define as to include now, we can lose sight of that. I mean, we remember what happened, but do we really in our gut remember what happened, And I think sometimes we can get carried away by a market that seems to go up and up and up. But when bad things happen, they tend to happen in a lot of different areas at the same time. And that's just not when I want to see my emergency fund going down in value. So that's our approach. That's what we do. And that's why we do it. So there is an issue with online banks. And that is when you want to get your money, it doesn't happen quickly, right? So the way we get money out of Ally, log in, transfer it to our brick and mortar bank. And it can happen in a day, depends when you need it. If you need it on a Friday night, forget about it. It ain't happening. You ain't getting it till Monday, probably Tuesday. And that is a problem. And my solution to that problem has been, as I think I mentioned earlier, keeping some amount of money in our brick and mortar bank that I can get to right away. However, in the discussion on the Facebook group, some folks had some excellent, two in particular, sort of really good workarounds that frankly are much better than my solution. My solution of keeping some money in the brick and mortar bank that pays no interest, again, not the end of the world, not a horrible solution. But the folks in the Facebook group came up with two other options, both of which I think are a lot better. And that's one of the things I like about the Facebook group. You guys teach me stuff. So I wanted to share these two, and then we'll finish up with, I'll give you some ideas as to where you can find online banks if you don't have one, and how you can compare interest rates, right? So let's do that, those three things, and we'll call it a day. So the first sort of solution to the problem of how do you get access to your money quickly is to open up an Ally checking account, right? And with an Ally checking account, you can get a debit card. And they actually pay interest on their checking account. Not that you have to keep a lot of money in there, because you can get online and transfer instantly between Ally Savings and Ally Checking, and then use your debit card, right? So it seems kind of like an obvious solution. You're saying, Rob, really? You never thought of that? Well, what can I tell you? I never thought of it. If your balance is less than, I'm looking at Ally now, if your balance is less than $15,000, you earn 10 basis points, obviously not a lot of money. If it's above $15,000 and it's your minimum daily balance, you earn 60 basis points. I'm not even looking to keep a lot in that checking account, but it is a way to get at your money very quickly. And I think it's a great idea. So I'm likely going to be opening up an Ally checking account. That's the first kind of solution. There's another way to do it. And this came in too, a second sort of way, and this I'm sure will work with other online banks, but I'm familiar with it. Actually, I've used this solution through Chase Bank. It just never occurred to me to use it in the context of my emergency fund. Again, sometimes I'm slow, don't know what to tell you. Quick Pay with Zelle, Z-E-L-L-E. I kind of think of it as Venmo, but I'm sure it's not quite like Venmo, but it's basically a way to get at your money quickly. I've used it with Chase because my best friend from high school, as I think I've mentioned in past podcasts, we own real estate together. By the way, I think I'm selling all of my properties this year. That's maybe for another podcast. But he had to get some money to me from our account, which, in 2018, you think this would be easy, but it's kind of not always easy. Well, Quick Pay with Zelle makes it easy. He did whatever he did on his end with Quick Pay with Zelle through Chase Bank. I got an email, accepted the money, had to connect a bank account, and it was in my account immediately. Boom, just like that. Well, you can do the same thing with online banks, or at least I know you can do it with Ally. So that would be another way to get money from your online bank to your brick and mortar bank instantly. Quick Pay with Zelle. So a reader mentioned that, in the Facebook group. I wanted to pass it on. I think it's a great alternative. So, I still think I'll probably keep some money in my brick and mortar bank. I don't know. There's just something about not having, I can't imagine logging into my brick and mortar bank and seeing a zero in the savings account. It would probably more of an emotional thing than a logical thing. But be that as it may, the Quick Pay with Zelle and or the Ally checking account, great ways to get access to your money in an online bank very, very quickly. And again, I'm sure this can work with many online banks. So I wanted to pass those two ideas along to you that you may find them helpful. So now, where do you find good online banks to compare rates? Well, of course, doorroller.net's the answer to that, right? If you go to doorroller.net, you'll see us on the home page. There's links right below the main picture. One of them is savings accounts. And if you click on that, you'll see reviews of a number of accounts. And you'll also see they have a bank rate widget. So I'm looking at it now. And you can compare a bunch of rates. Let's see, Capital One 360 is paying 185 basis points. So is Barclays. So is Marcus, which is the Goldman Sachs bank. Amex is paying 180. Let's see, where's Ally? Ally is paying, I think, 180. Yeah, 180. But in any event, you can just go right down. You can, through the widget, you can see I think a lot of the great banks, they actually have a ton of them. It looks like 180. There's actually a couple that pay 2%, although some of them have minimum requirements, which may or may not be an issue for you. Some of them I've never heard of. So you want to obviously do your due diligence. I'm guessing these are all FDIC insured, which is really the main thing you want to know. But you'll see a whole bunch of options there. You can check them out. And they have CIT Bank. Looks like it's paying 185 basis points. Synchrony is paying 185 basis points. So a lot of good options. And, you can check them out and find what works for you. Again, there was a time when I sort of chased interest rates. That's why, as I mentioned earlier, I've had accounts at a lot of different banks. I kind of got tired of that. I just don't do that anymore. I'm happy at Ally and what they pay. I could move it and maybe make 5 or 10 basis points more. Not going to do it. It's just not worth it. And if I did it, then a month from now, Ally could have a higher rate. And I'd just be bouncing back and forth. So, pick whatever works for you. And it could be a great way to store your emergency fund. In terms of trying to earn a higher yield, let me kind of finish with this point. There are other options, right, besides what I've listed on one end, and say equities, right, or high yield bonds on the other. You could go with an intermediate term bond fund. So that would be, think of a bond fund that has a duration of about 5 to 7 years. Duration is a little bit different than maturity. We've talked about it. Not going to dive into it now, but roughly it means when the bonds mature, although it doesn't technically actually mean that, but it's close enough right now. And I should do a whole podcast on maturity versus duration. In any event, think 5 to 7 years. Can those go down in value? Yes. So the rule of thumb is if interest rates go up by 1%, a bond fund goes down by 1% equal to its duration. Did you follow that? So if a bond fund has a duration of 5 years and interest rates go up 1%, the value of those bonds in that fund will go down 5%. Right? So that sounds scary, except that interest rates, they certainly can creep up, but they tend to creep up slowly. And it's a risk-reward thing. You could go with an intermediate term bond fund. And it's going to yield a little more, although now still the yields are really, really low. But another option is a certificate of deposit. And you might be able to you can get a higher yield. Again, the downside there is that if you need your money right away, you could lose some interest in the form of an early withdrawal penalty. They do have no penalty CDs. Ally has one, for example. And in fact, if you have a $25,000 minimum deposit, I'm looking at it now, you can get an 11-month CD that's no penalty for pulling the money out at 2%. That's actually not a bad deal as I look at it. I may throw some money in there. Why not? One thing to keep in mind with the CD, with a savings account, you want to make a withdrawal, you take out, whatever you want. If you've got $10,000 in your savings account, you want to take out $20, no problem. You want to take out $2,000, no problem. With a CD, if you were going to close it, and in this case, no penalty CD, fine, there's no penalty. But keep in mind, it's all or nothing, right? You can't just call up and say, well, I put $25,000 into the CD, I want to take out $500. It doesn't work that way. You have to pull it all out. Now, maybe not a big deal because you can pull it out, spend what you need and put the rest back in, or put the rest back into an online savings account. But the point is, keep that in mind with certificates of deposit. When you close them, you have to take all the money out. But it's a way to maybe earn a little more interest. As I said, this no penalty CD, if you've got 25 grand, is 2%, and their high yield CD, let's say for 1 year, it's 2.25%. Again, you got to have at least 5,000 to earn that yield. Actually, if you have 25,000, you earn 2.5%. But again, there you have to keep your money in for 12 months. If you don't, if you pull it out early, you'll have an early withdrawal penalty. Some folks do a CD ladder where you end up with like 5-year CDs, but you have like 5 of them, and they each mature, say, a year apart. Or you could have 10 of them and they could each mature 6 months apart or whatever. The point is that you would always sort of have this rolling access to some amount of your emergency fund. None of these options are foolproof, right? You're either going to earn a lower rate because it's just a savings account, or you might earn a higher rate, but you're going to have some issues potentially depending on if you need the money. you're going to just have to assess for yourself, which combination of all of this makes the most sense. Again, you might do a little of everything. You might have some in a traditional bank, some in an online bank, and a savings account, and some in a certificate of deposit. I mean, that works fine as well. Well, there you go. Appreciate the question in the Facebook group. Thank you, Jacob. Excellent question. The discussion was phenomenal. If you're not a member of the Facebook group, highly encourage it. Just go to doorruler.net/Facebook group. Hope you all have a great week. And until next time, remember, the best thing money can buy is financial freedom.